We are so pleased to share our macro and markets outlook for 2026.
Starting with the United States, the tension between strong economic growth on one hand, but already rich valuations on the other, have investors wary of what the new year might look like. But when we focus on fundamentals, our base case for economic activity and capital markets conditions over the next 12 months is actually quite constructive.
The first pillar of this constructive view is based on our conviction that the AI boom has room to run. Because AI has been such a concentrated driver of financial conditions, we expect to see positive spillover between ongoing strength in both earnings and capital expenditures across the AI supply chain.
Our outlook also hinges on a supportive U.S. policy environment in 2026. On the monetary policy side, we expect modest Fed easing and targeted liquidity support. On the fiscal side, we expect a pro-growth policy bias ahead of the U.S. midterm elections. We already have visibility into the supportive elements of the One Big Beautiful Bill Act, including the return of 100% CapEx depreciation and total R&D expensing, which should support corporate investment in the coming year.
We expect these factors, the AI boom and supportive policy, to enable a virtuous cycle of resilient corporate profitability, consumer spending, and employment conditions.
Globally, we're expecting an environment where the geopolitical backdrop is likely to be supportive of diversification across regions, currencies, and asset classes. And we expect neutral to supportive policy backdrop to support Japan, emerging markets like China, and Europe in 2026. But the US economy may still outperform, and so any diversification wholesale away from the US is likely to be gradual.
This market backdrop should support further improvements in private market activity. We remain optimistic about private markets' resilience, thanks to strong credit quality, new sources of liquidity, and democratization of access.
This is a constructive base case, and that reasonable backdrop, good fiscal and monetary support, may mean that leverage builds in the system over time. But we expect these risks may be building over the course of 2026, not breaking. And so the way we balance that is in an allocation is to stay fully invested while being very focused on two key themes: diversification and quality.
Diversification has always mattered theoretically, but the last 15 years of lower for longer interest rates and stable U.S. outperformance have driven visible shifts in portfolio construction. Portfolios have shifted more towards equity, more towards U.S. assets, and even more towards unhedged exposures. In 2026, we expect investors to continue recalibrating, rebalancing regional allocations, currency exposures, and inflation hedges.
Similarly, quality hasn't consistently paid over the last 15 years, as lower for longer has encouraged excessive risk-taking. But as the U.S. credit cycle matures, we expect credit conditions to shift in favor of discipline and selectivity.
Accordingly, we're making the following shifts in allocations. First, we're staying invested at a market weight neutral level in U.S. large cap equities, including large cap tech. Then there's the question of how to deploy new capital in today's equity environment. Here, we are upgrading our conviction on U.S. small cap equity from underweight to neutral, focused on high quality names there. We also like the diversifying potential of new additions in U.S. financials, materials, energy, and digital infrastructure, as well as developed market ex-U.S. equities. On the fixed income side, within a core bond allocation, we favor structured credit. We're keeping our corporate credit exposure shorter on duration and balancing that with longer duration exposure in municipal bonds.
To read our full base case, top risks, asset allocation convictions, and the geopolitical context underpinning our views, you can see our latest issue of Macro Pulse at newyorklifeinvestments.com/global-markets. We wish you a wonderful holiday season and look forward to working together in 2026.